Hello, welcome to the financial forecasting package overview of the introduction to the innovation journey. I'm Peter Towers, Managing Director of BIZTOOls. I hope you're having a wonderful day. Let's look at the start of innovation. This is interesting and an exciting concept of accounting services to your SME clients. So what we're looking at today is the way ESS BizTools has been drafted to assist you to be giving value-adding advice to your SME clients because they really need it. There's a lot of problems out there at present. High interest rates, high inflation, business failures, a lot of uncertainty. Yet there are people out there, potentially some of your clients, or most definitely some of your prospects, who are undertaking innovative activities. And this offers significant opportunities for progressive accounting firms to be involved, to assist them on this journey. So let's go through it, have a look at where it all starts. I think it starts with an idea that could then become a project. Your client will need to appoint a small team to conduct preliminary investigations. And yes, this is all about research and development. This is how a research and development project starts. And in ESS BizTools, we have a complete package from the idea through to the finalization of the company's tax return, claiming the research and development tax rebate. And on the way, you've submitted the return to Oz Industry. But let's go through the process. So the eligibility for research and development tax rebate is probably where you need to start with your client as soon as possible. Once you realize that they are committed to conducting research and development projects, you need to talk to them about how they can obtain the benefit of the tax rebate. They need to be an incorporated company, not just an entity that's called a company. It's really a sole trader. They need to be an incorporated company. And they need to have incurred legitimate research and development expenditure over $20,000 in the financial year. They need to keep records. It's their responsibility, not yours. Conduct prior art searches. Now, they may need some advice from a patent attorney in conducting those searches. Your role, as I see it, is refer them to a patent attorney. And if you don't know any patent attorneys, perhaps now's the time to make some inquiries and find out which patent attorneys are in your area. Most patent attorneys are very keen to assist because they get a significant amount of their work from small SME type businesses. So they know that they should be helping you to guide them. They need to be able to document the prior art searches. Now, what this is checking on the internet, checking in records, books, to see whether somewhere else in the world has already patented this idea. If so, the Australian government is not going to give your client a special taxation benefit to repeat the process in Australia. And when they're undertaking their prior art searches, they need to keep the documents. It's no use saying, oh, we did some searches on the internet and we couldn't find anyone else that had developed this, and therefore we think we're eligible for the research and development tax rebate. That's not the way it works. They need to print out the pages they've looked at that they believe signifies that no one else has already been down this path. And they need to make sure those documents are dated, because it might be 3 or 4 years' time before they get involved in a potential fight with the tax office. And someone may well have patented the same concept 2 years later on. We need to be able to produce the documentation, or you need to be able to produce the documentation that when they searched, no one had registered that patent. They need to identify the core activities proposed from the research. There needs to be one very important core activity that is summarized in the hypothesis. This is what we're setting out to prove, one way or the other. Incidentally, it doesn't matter whether this is a complete failure from a research point of view, as long as the documentation's kept, your client will still be able to claim the research and development tax rebate. Doesn't have to be successful. The government knows that a lot of the work in research and development will not be successful. And they also know that unless people are committed to undertaking research, new ideas will not be unearthed. So in this preliminary phase, your client needs to jot down what new knowledge they intend to produce. Now, at the end of the day, it might seem a strange list, but that's what the legislation requires to be kept. So make sure your client has sat down and identified what they're trying to achieve, what new knowledge. It's like a business plan on a research and development project. Now, the outcome cannot be known or determined in advance on the basis of current knowledge, information, or experience. Now, that's fairly wide. So your client may have to go up and talk to an expert and just make sure that that knowledge is not already known in the marketplace or in scientific circles, because there's a fair chance then that Industry or the tax office can do exactly the same and find out that what your client's been advocating has been common knowledge in scientific circles for 5 years, 10 years. And the knowledge can only be determined by applying a systematic progression of work. You'll notice a lot of this terminology is straight out of a university textbook approach. And that is the case because the R&D process has been based on what the government and the tax office believes is the university's approach to research. So businesses that are wanting to claim the benefits have to do likewise. So they need to be identifying in their business plan for research and development how they're going to go about this project. It's not just a matter of waking up the day and saying, oh, well, we'll go and do something different. At the beginning, get them to jot down how they think they're going to go about proving that something will work. And they may have some alternatives, of course. If that doesn't work, we then do this. Jot it down, put it in the book. Keep the files. I mentioned before one of the key things out of all this is we're trying to identify an hypothesis or hypotheses. There may be a number of them, which is true or false type statement. This is what we are going to try to prove from this research. Our recommendation is that all SME clients should produce a research and development plan. That's not the law. It's only the law for larger companies, turnovers over $20 million. They need a plan. I think everyone should produce a plan because a lot of the information I've just been talking to you about on the hypothesis and the identification of the outcomes that you're trying to achieve, all that is best incorporated within a research and development plan. Now, all the forms that you require for every step that we've just discussed, and there are some more that I haven't included in this particular overview, are all within the ESS BIZTOOLS research and development product package. In fact, there are 46 forms there. I very much doubt if any one client's going to require all 46 forms. But if you do 10, 15 of these research and development claims over a year, you may find you need nearly all that 46 forms because of the peculiarities of different clients. the legislation assumes that your client is going to take this to a board of directors. So the plan and the report should then be submitted to the board of directors for approval, because this is based on what the big end of town would do. The big end of town, it would go to either a senior executive for authorization to expend the dollars on undertaking this research, or it would go to the board of directors. I think we should formalize it, and it's going to the board of directors, even if at this stage you've got a one director company. The person has to sit down and approve the documentation. And the approval should be noted in the minutes, and within ESS BIZTOOLS, we've got a standard minute there that you can utilize to indicate the board of directors has approved of this process. So then we get underway. We're ready to go. Well, a team needs to be appointed, and it's highly recommended that you make sure every person that's going to be involved in this from the client's team are noted, not just saying all the staff. We need their names. And then we need to document any external advisors or consultants or university people who are going to be involved in the project or who are brought onto the project. Make sure there's always a record of who they are. And confidentiality agreements. Confidentiality agreements are very important for external contractors and advisors. Team members depends on their employment agreement. There's been some cases over the years, though, that you probably should look at, where one of them, my memory serves me correctly, the girlfriend of one of the developers used to turn up to take him home at night, and she would sit in the corner and was reading a book, but was also listening to what was going on, and every so often would make some suggestions. She hadn't signed a confidentiality agreement, and there was litigation about that later on when she made some comments. Perhaps she split up with a boyfriend, I don't know. But you need to make sure your client's aware of this and perhaps get some legal advice. They need to keep records of the hours worked on the project. That's by the client's team, because we're going to be able to claim that labour and the labour on cost as part of the research and development project. So we need documentation to be submitted. And the same thing applies for external professionals. They will normally, or contractors, they will submit tax invoices. We need to be allocating to that particular project they were working on, because within a research and development assignment, there could be 10, 20 different aspects that's being worked on. And we have got some suggested task codes within ESS BIZTOOLS that you can look at and you can use, or you can modify to suit the client's own circumstances. So instead of people having to write down a detailed description of what they did every day on a project, it might be they just write down T10, if that's the abbreviation for that phraseology, to save time. And that will, I think, lead to more accurate recording. And all of these records are very important. And then we need to go through the systematic progression of work. What are the experiments being conducted, the records kept, the team meetings to review the results, reports going back to the board of directors. I think they should go back every month. And then at the end of the day, we've got reports that have to be prepared. The due diligence records for all R&D activities need to be assembled. Now, this is your client's responsibility to keep these. We've detailed all the forms that we believe you will need. They're in the ESS BIZTOOLS product package that you can download. Show your client what's required, specify to them the ones that they need to be completing. Make sure they do it. I see your role as being an internal auditor. You're not the instigator of all this. You're not conducting the experiments. That is your client's responsibility. And you need to make sure that they understand that. At the end of the financial year, the completion of well, it's not the end of the financial year, sorry. The report that has to be submitted to Oz Industry to start the reporting process proceeding has to be lodged within 10 months of the end of the financial year. Now, for 30th of June end, that's the 30th of April the following year. a word of advice, try to get that document lodged a lot earlier than the 30th of April, because Oz industry get inundated with these returns in the month of April, and it takes them weeks to process them. And until they process them, you will not get their approval number, which they send back to you to be included in the company's income tax return, so that the return can be lodged and the research and development tax rebate can be claimed or paid out. And I'll come back to the paying out in a moment. So the form's submitted and goes to Oz Industries. Oz Industries send the approval number back. You then incorporate that on the company's income tax return. And if the company has a turnover under $20 million, the research and development rebate will be calculated at 43.5% of the eligible research and development expenditure. That's the company tax rate plus 18.5%. So if the company has undertaken that activity and they are trading at a loss, they can claim in the tax return for the cash amount of the rebate to be paid back to them. And the tax office do that within 30 days of the tax return being lodged. So that's a key way for your client to be getting some new finance money, 43.5% of what they spend. It's not 100%, of course. And it's the reason that some of your clients will be on your backs probably from mid-August wanting to get all of this finished. The return that has to go to Oz Industry so that they can finish the process, and they'll do it a lot quicker at that time of the year. And then the company's tax return is lodged so that they can have an expectation that by October, November, they may be getting that refund of the 43.5% of the expenditure paid into their bank account. So the funding of research and development. Entrepreneurial companies normally spend their own money in the research and development activities to get started because they've really got no story to tell anyone else to invest with them. And the cash funding opportunity from the tax office is available, as I just said, and they can claim that in their tax return to be refunded to them, so long as the company's losses exceed the calculation of the R&D rebate. If not, the tax office will only pay to them what the value of the tax losses are. At this stage, your client needs to make a decision. Is this a project that looks good? Is there some commercial benefits emerging? They could decide to try to raise some funds from someone. Now, someone could include the Australian government because there's grants, which I'm going to refer to in a moment. But it's where the innovation journey gets interesting, because some big decisions need to be made by your client and by you as the key advisor, because there's some additional information going to be required. And this is the interesting and challenging work. The first concept that you might look at, and all of this is summarised within ESS BIZTOOLS, is the early stage innovation company. This type of company commenced 7 years ago. It's there to assist young companies to raise capital with a strong preference for companies that have undertaken research and development activities. The benefits for a company achieving the status of an early stage innovation company are that the government offers an incentive for investors. Now, I've never come across anywhere else in Australian legislation where the government's offering an incentive to a company to invest in a small private company. But that's what's the situation here. And the incentive is that the investor receives 20% of their investment that they've made as part of this status approval for the company to be an early stage innovation company. 20% of their investment. Now, if they're a sophisticated investor, the maximum amount of that rebate is $200,000, which comes off their tax bill. And if they're a retail investor, the maximum amount is $10,000 because the maximum investment that a retail investor can make in a 12-month period in a early stage innovation company is $50,000. That's because the government wanted the investment risk spread. And the investor is not liable for capital gains tax on the sale of the shares allocated as part of this status determination process if they hold those shares for more than 12 months and less than 10 years. And at the end of 10 years, the company's revalued and the shareholder has a new cost price for their investment in the company. So that's not bad, is it? Really helps these companies out. But there's a bit more we need to consider. We have within the ESS BIZTOOLS product package the Early Stage Innovation Company Calculator, which will guide you through this whole process. I've abbreviated it somewhat, and I'm just going to give you a brief overview now. The first type of company can be one that's incorporated in the last 3 years. I indicated to you before, this is there to support young companies. Not young executives, but young companies. Did the company and its 100% subsidiaries incur total expenses of $1 million or less in the income year before the current year? So the last income year, did they spend less than $1 million? And did the company and its subsidiaries have total assessable income of $200,000 or less, not including any accelerating commercialization grant? And that was also in the income year before the current year. If the company satisfies these tests, it is deemed to have satisfied the test time determination. Now there's more. A company incorporated in the last 6 years, it's a little bit different. Over the last 3 of those income years, has the company and its 100% subsidiaries incurred total expenses of $1 million or less? That's over the 3-year period. And did the company and its 100% subsidiaries have total assessable income of less than $200,000, again excluding any accelerating commercialization grant, in the income year before the current year? Now, if it did that, it is past the test time determination. The company then has to pass either the gateway test or the principles test. So the test time determination is the entry fee, if you like. We then go to the gateway test. Now you can look at the calculator that I referred to earlier on the website, because this particular webinar is not on the Early Stage Innovation Company. We're looking at innovation overall. But in the gateway test, there's about 10 separate questions that the company earns points. The highest points are rated for research and development activities. Company's got to earn 100 points. If it spent more than 50% of its expenditure up to $1 million in the year or the period being considered, if it's over 50% of its total expenditure, they earn 75 points. They haven't got to go very far then to get 100, have they? And if they've spent from 15% up to 49.9% of their expenditure on research and development, they achieve 50 points. So that it's weighted. If they've already been admitted to the accelerating commercialization grant, they earn 50 points. And it so goes on. And you can have a look at that yourselves, please. And if you've got any questions, please contact me or watch the webinars which we've got on the site for the Early Stage Innovation Company. Now, if they can't accumulate 100 points, or they know that they haven't done any of those sort of activities, so they don't even bother looking at the gateway test. They can then move on to the principles test. In the principles test, there's 5 questions, which are asking details to be submitted of what the company's all about, what this activity is all about. I don't suggest that anyone replies on a yes-no basis. I think they're looking for some detailed responses. I've had one assignment that I did a few years ago where I received about 18 pages of material from a consultant who was asked to comment on the potential benefit of this sort of product, how it would go in the marketplace. My suggestion is that there should be at least one A4 page submitted to answer each question. And if you've got 18 pages of information or more that you want to submit to answer one of the questions, that's okay. But you need to give them some information, because these questions are very similar to some of the questions that Oz Industry ask in some of their programs, and they're looking for detailed responses. I know, because I did consult to Oz Industry on the predecessor program to accelerating commercialization. So if you consider that you've answered the principles test, you then submit that report and other information that we've specified in the material that you've got to look at to the tax office, and they then make a decision, them and Oz Industry. But if you have passed the gateway test, you've recorded that you've got more than 100 points, and you've kept all the supporting documentation, because you'll need that, but you don't need to submit it at this stage to the tax office, because the official answer is you have self-assessed. And on our documentation, we've got a form that you would complete and get your clients to sign it, that they could submit to any potential investors at that stage. The benefit of this legislation is that the government has supplied an incentive to investors to invest in this type of business. It's the prerequisite to be able to raise capital. Now, you just don't go through this process and then turn around and say, well, okay, who's going to invest with us? And they should do so now because they're going to get this taxation advantage. It doesn't work that way. Your client needs a business plan, predictive accounting reports, budgets, key drivers of the key items like debtors, creditors, research and development, capital expenditure, cash flow forecasts, projected balance sheets. They need an understanding of corporate governance, and they need an understanding of the way the early stage innovation company process works. They've still got to go through all that. All the government is done is giving them the opportunity to be attractive to would-be investors. They still need those documents. And in the vast majority of instances, I imagine that you're going to be the person or the firm coordinating all this, preparing it in conjunction with the client's leadership team and directors, and getting that documentation right. Because the investors will want that documentation along with the status either determined under the gateway test, which is self-assessed, or under the principles test, which will be a certificate received back from the tax office. It takes them about 6 weeks to issue that certificate once the company information has been lodged. So that's the innovation stage that you may or may not recommend to your client. In lots of cases, depending on the age of the company and what they've been doing. Have they been spending more than $1 million a year? Has their income been higher than $200,000? We could then go to Section 708 of the Corporations Act. It's been around for about 40 years. It was in the state legislation before we had the Uniform Companies Act that started in about 2000 or 2001. Section 708. Private company can raise up to $2 million in a 12-month period from a maximum of 20 investors. There can be no marketing or advertising on the capital raising. The capital raising is limited to people who are aware of what the company is doing. So it's friends, suppliers, customers, employees, or people who have got to know your client's activities because they're developed a website that's got information about what's going on. Now, they're not going to reveal all their secrets, but they can start communicating, especially if their research is targeted at a particular industry. Make sure the people in the industry have an understanding of what they're doing, so that when they're looking to raise capital, these people are informed. They might be suppliers, they might be customers, but they know what the company is doing, and they can then comply with that definition contained in section 708. So that's the second corporate entity you can go to raise capital. The third one I want to discuss with you is crowdsourced funding equity raising. Now, this was the stablemate to early stage innovation company. Private companies and unlisted public companies can raise capital as long as their international sales are under $25 million and the gross value of their assets worldwide are under $25 million. The directors, majority of directors, need to live in Australia, and they're not listed on a stock exchange anywhere in the world. Okay, so if they pass all that, this could be of interest to a company that has undertaken research and development activity, so they're wanting to go on the innovation journey, but they don't qualify because the 3-year or the 6-year test, they're a 10-year-old company. They may have a turnover of $3 or $4 million, so they're definitely more than $200,000, and their expenditure might be $2 million, $2.5 million. So they can't qualify there, but they might qualify here. Now, they've got to be able to then produce the same sort of documentation we talked about for early stage innovation companies, the business plan, the budgets, the cash flow forecast. And now they need to have an understanding of the crowdsourced funding equity raising process because it's different. And they might be excited by that they could raise up to $5 million in a 12-month period. They need to be able to talk to a crowdsourced funding intermediary. There are 16 intermediary licenses in Australia. Unfortunately, there's only 4 intermediaries that appear to be 100% of their time spent in this process. I'd like to see 16 of them flat out, to be honest. And that gets back to the accountancy industry, encouraging SMEs to take this step and try to raise capital. But that's another story. So they can raise $5 million in a 12-month period. Now, there's a government grant, but all government grants require a similar amount being contributed by the company. That's one of the reasons we've looked at how a company can get money. Now, if they've got the money in the bank, that's fantastic, but most haven't, in my experience. The government has launched the Industry Growth Program. It's the replacement to Accelerating Commercialisation Grant, and it's got off to a rather slow start, but it has recently handed out its first lot of grant funds. Now, they range from $137,000 to $4.6 million for the funding. Now, that's got to be matched by the companies, so it's well worth looking at. The company, though, requires a turnover of under $20 million. So some companies that might qualify for crowdsourced funding equity raising might miss out on this particular grant if their turnover is over $20 million. So raising capital as an early stage innovation company, crowdsourced funding company, or Section 708 of the Corporations Act is a process that will generate funds for your client's company to be able to match the government funding. And when you're in these processes with the government, they do allow time, 3-4 months, for the capital raising process to be approved. So you can submit an application for the grant on the basis that the company is going through an early stage innovation company process, or Section 708 of the Corporations Act, or crowdsourced funding equity raising, and you expect it to be finished. We can only go for 90 days in crowdsourced funding in any case. So if you've made it 4 or 5 months down the track, keep the government's advisor informed of what's going on. The government will wait. This is all through Oz Industry. They will wait until you have confirmed that the money's available. and they will then see it come in, and everyone will be happy. And your client can get on with the commercialization process, because that's what all this is about. They've done the research and development. They've developed a prototype. They've sat down and said, Jesus, this has got some commercial benefits. We can really take this to the market. Now, not every client who commences a research and development project will complete the innovation journey, unfortunately, but that's facts of life. That won't occur. But many companies do, because they have developed a new product or service that improves the valuation of the company and can generate additional revenue for the company by them going into full production, marketing and selling the product. Alternatively, the directors may decide, well, we're going to sell this completed product to a larger organisation or a specialist organisation, and we will receive money for that. We may receive ongoing income on some sort of royalty basis, and we will use that money to develop further products. And I know some companies that do that. They don't really want to go into the market to have to sell a new widget on an Australian-wide or worldwide basis. What all this does, though, is give some very interesting and challenging work to your accounting firm, because these clients all need assistance. They need the business plan, the budgets, understanding of corporate governance, understanding of crowdsourced funding, equity raising. What's the duties and responsibilities and powers of the crowdsourced funding intermediaries? How does early stage innovation companies work? At what stage can you approach the investors? So that's the journey on innovation. It will definitely give your firm some interesting and challenging work. I get stories from accountants around Australia saying that there's a talent problem in attraction. There's a problem in retaining talent in firms. I think this type of work activity within your firm will create a lot of interest and will help with your talent retention and attraction into your firm. Now, if you want to talk to me more about the actual implementation and everything relating to the innovation journey, don't hold back. Make a phone call, send me an email, peter@essbiztools.com.au, and I'll be happy to talk to you. And we can come to an arrangement on supply of additional services, because you'll see that they're listed on our website, additional training over and above our commitment to training that we offer every month in these webinar recordings. So good luck with this process. It's an interesting journey, and I wish you every success on helping your clients commence, undertake, and complete the innovation journey. Thank you. Thank you for your support. Goodbye. And as I said, if you have any questions, comments, please contact us. Have a great day. Goodbye.